Hello everybody, I'm the Boss Hog and this is my wealth review as of the start of May 2021, which currently totals 254,000. Woo! Quarter of a million. But before we get too excited, because this is a month earlier than I was expecting to hit it, this is slightly timing, and so I don't want to game it too much. So that is currently what our wealth is, but it's going to be eaten away as expenses, etc. come out during the month. But still, let's have a look and see how we're doing, and we'll go from there. Okay, so in terms of total welfare, you can see that I'm basically running a month ahead, but this is partly timing. So in the past, I was doing for February and March, I did the 11th of Feb and the 11th of March, so that was after a lot of the monthly expenses had gone out. This is technically at the end of April / the start of May, and so we'd been paid effectively. So all of our April expenses had gone out, and then we get paid, which is technically for April's work, but just that change has kind of changed it a little bit. I think that's fair to say. So although I think we were well on target to hit the $250,000 for May, which is still the target, the fact that I've kind of changed when we're doing this just makes it easier basically. So this month will be a bit of a change, and then from next month we'll just start a new normal. But yeah, as a result of that change, the fact we have our salaries but haven't yet had the May expenses come out, that means that we're now at this level. So I mean, to me it's super good in a way, but I'm also not kidding myself that by the end of May we'll be back under 250, so we'll go from there. But it's really great to see that line, so it is what it is. I'm quite excited. Okay, so here's our high-level summary. As expected, most of our wealth is in our home. We have a London two-bed flat. London flats are very expensive. As you'll see in a second, we own about 30% of our equity in our building. Pensions, ISAs, all of them moved in the right direction basically during April, so we added from that perspective. You can see here that the ISAs specifically did super well. Part of that is because of the performance, part of it was also because we added quite a lot of money to it, so that definitely boosted that. But even our pensions moved in the right direction there, and that's not a mistype by the way on my pension, it just happens to be exactly 56,000 on the dot, so that feels really good. And my wife's, there was an issue with her pension when she returned to work following maternity leave, but that's now started being contributed to as well. So that had been flat for a year, but that's being fixed and is starting to show improvements as a result of it, so that feels really good. In terms of other, this is an IOU at the moment basically, but so that also saw a decrease in what we owe, or the shortfall, so that's also an improvement basically. The other reason as well that our ISAs grew so much is because our non-ISAs, I sold a lot of the recovery stocks and moved them over into the more tax efficient investment vehicle, so they actually saw a decrease as a result of that, but still contributing toward our wealth. Okay, and home equity, this is one of those things where I really wish we were at 30%, just because completely arbitrary reasons, because it's a new cool round number. I haven't had the home revalued since we bought it. This is based on a property website from a very similar two-bed flat that sold, so I think this is a reasonable home value. In the future I would actually like to get it formally valued, but we'll see. We continue to reduce our mortgage basically. We've got a 2.4% mortgage, I think it is. Whether that's good or not I'm not sure, I think it's respectable, and we're 2/3 of the way for a 3-year fixed rate, so we just continue to pay basically and make contributions toward our mortgage. Okay, now for the slightly juicy stuff. So Nutmeg is my previous employer's consolidated pension, so that's not having any new money put into it, and I actually saw really positive movement. I did make changes to both my wife and my's pension pots. This is the UK, so these pensions are run by insurance companies, and they were just set up incredibly risk adverse. So a couple of months ago I made changes to make things more adventurous, I think is the wording, and that seemingly has done a good result, at least over April. Admittedly it's just a month in isolation, right, but in the long term I'm really confident with the changes I've made. Standard Life is my active employer. I have to say I really like the portal. I'm actually considering moving my Nutmeg into Standard Life. Certainly when I move jobs, which I've mentioned in a previous video, in a few months, I'll probably actually move my Nutmeg into my Standard Life, consolidate all of my previous over to there. Just think the portal is super friendly and they've got a really good wide range of ETFs to invest in, and then whoever my new employer has for their pension provider, I'll just start a new one again basically. basically. My wife's pension is in the process of going with the people's pension, but I haven't quite got all the paperwork yet, so I've kind of lumped this all together. I will break that out next month, but it's quite a modest number at the moment. On the good side, my wife has now returned to work, is paying into her pension again, and also the delay from moving from Royal London into people's pension has seemingly started to work itself out. So we'll see how that goes. But again, moving in the right direction, and made changes to Royal London as well to move from risk adverse to a more adventurous portfolio. So we continue to move in the right direction basically for those as well, which feels great. Okay, shares and more shares. I'm really enjoying trading shares. It's super fun for me. We added quite a lot into our portfolio. We also got about 2,000 profit. I've got a video describing how and what my holdings are on that as well. So that felt really good. And we've also sold out of all of our, or most of our non-ISA shares as well. I think I've actually down to 2 whole companies in outside of the ISAs. I do include our daughter's. She's got a junior ISA. We're doing £100 a month into that, so she's 15 months old now. So she's sitting on £109 profit. The reason why I include this in our wealth, I appreciate it's not, but right now she's 15 months old, so she is basically our dependent, and so I guess I kind of view it as our sort of collective familial wealth. Obviously, once she's turned 16, she gets made aware of that. I'll actually probably choose to make her aware of it beforehand. Once she's 18, it's completely hers. She can do with it what she wants. So I'm hoping by then she'll be a perfectly sensible 18-year-old. What could go wrong? But yeah, that's the plan basically. So we had some good growth on our shares. And again, that's also contributed toward a faster than expected accumulation of wealth so far, at least. Okay, and lastly on other, so we have a joint bank account that we keep more than 6 months expenses on. This is closing in on a year. We are gradually moving that into stocks and shares, but I'm basically buying in over a long period of time. Also as well, the IOU there is basically could be called in the not too distant future. So by having sort of a figure that's materially close to that, if there was an ask, it would be relatively straightforward, you know, given 3 months for my wife and I to kind of fill in the difference. Also as well, now that my wife is returned to work and working full time, like she contributes about 40% of our net income, so that will make a big difference in terms of our joint bank account. So over time I expect that to increase actually, even though we're adding quite a lot to our ISAs. Outside of that though, my wife's quite slow apparently transferring from her own bank account into our joint one, so we've also got that 3 and a bit thousand there to come over in due course. Outside of that though, most of the other things are relatively unchanged, so that just is what it is. At the moment our other technically reduces our wealth just because we would owe 4,000 if we were required to actually physically pay the IOU. So that's basically a debt that we're incurring. We're keeping enough money available so that if needed, we could provide for that, which is fine. That's what we agreed to do. So it's progressing basically. So to conclude, actual wealth is running far ahead of expectations, but that is also because of the difference in income and expenses. But this is the first month and the only month that would have to do that caveat. Broadly speaking, like you could think of it another way and say that we should really have about 258 against 254. So we're still running ahead of schedule, but it does feel really great. Most things are in line with my expectations, and actually our shares are performing better than I was expecting, which also as well our shares on our ETFs in our private pensions are also performing better than I was expecting. So I've annualized our ISAs at 8% a year and our pensions at 6% a year. The reason for the pensions is because they're run more conservatively, and there's also a management fee on those as well. So I've kind of done a fairly, at least, pessimistic long-term rate of return on those, but both our pensions and our ISAs are outperforming those assumptions, so that's contributing as well basically. Okay, so that's my/our wealth as it stands. The first time we've hit $250,000, a month earlier than I was expecting. It feels really good. I think it's going to feel better next month because it won't feel like I've gamed it from a timing perspective, but I feel really good about it basically. I came from relatively humble beginnings, and to imagine that I'm now sitting on some wealth well into the six figures and kind of $250,000 just feels really good. So that's everything as it stands currently, though. Yeah, thank you for watching. I've been the Boss Hog, and good luck, I suppose, with your wealth accumulating. Thanks very much, everybody.